Testing 1, 2. Never know if teams when recording starts. All right, guys. This is getting totally critical. Without wanting to sound too dramatic, I'm going to show you a couple of charts, and these 4 charts are a way to represent or visualize where our debt system is. So there's a debt, total U.S. public debt. And then there is the cost of servicing that debt, which is set by the Fed fund rate, the overnight lending rate. And there's points, if you play around with those two metrics, and then you add rate of change or technical analysis, you can summarize historically, since over 50, 60 years, what's happening right now and where we think either the Fed pivots, they lower rates, or there's a total implosion. So let's start with this chart, guys. There's 4 charts. This is going to be short. This is the first one I did. So here's the Fed fund rate. And each time this goes up, you see it's going up from 0 to wherever it is now. And it doesn't look quite impressive. But I know when you put the rate of change, so I put the rate of change, that 12-month rate of change to the Fed fund rate. And it's breaking out of a historical since 1958 descending trend line, horizontal breakout line. And I know when, like the Happy Hawaiian mentioned, when you move from like almost 0, let's say 0.01 to 0.02, that's 100% move. But we have precedent right here. We have just the Fed fund rates from all this period here, from 2009 all the way to 2017, 16, when it was flat. It didn't move from 0 line that aggressive, skyrocketing like it did today, right? It went slowly. So that rate of change stayed within the parameters, like almost like the 2005 rate cycle, etc., but it was contained. So that's just one part of the element. Indeed, you can't really compare that. Something special is happening when compared to what the previous rate cycle, when it went from 0 all the way up to wherever it stopped there, 3 or 4. So that's evidence exhibit A. So let's move to what's a little bit more important is I'll do this one here, guys. This is the total public debt multiplied by the Fed fund rate. So the logic is, if you want to, I call that the debt saturation analysis. So if you multiply the debt, whatever it is, so debt's growing, you have to multiply it against the Fed fund rate, because the Fed fund rate, as it rises, is going to put pressure on the serviceability of that debt. So that debt, is it sustainable? Well, if the interest rates keep going up, the payment's going to be higher and higher. You're going to need more GDP, it's going to cost more and more taxes to try to pay that down. And here it's going up. And you see here, I overlaid the recessions, guys. These recessions, they're cleansing. So they come like almost like clockwork. Recessions are more probable when there is a cleanse of the saturation. So as this goes up, the debt system is getting saturated, where there's too much debt for the Fed fund rate that's there, right? So it's multiplying, the Fed fund rate's going up, there's too much debt, and then you have to cleanse. So either the debt has to be reduced, which is rarely the case. It's more the Fed fund rate going down that makes this ratio go down, and the debt becomes sustainable. The servicing costs are less. So that's what I call down here, system debt serviceability is lowly saturated. So it cleansed through recession, goes back up, excesses, Fed fund rate keeps going up with the debt, but then after that, the system becomes saturated, and it needs a cleansing cycle through recession, goes up. See, each of these ones, these important moves down, the Fed fund rate's probably getting cut. It's a recession, you're cleansing here, 91, cleanse. Here, recession was here, but the cleansing lasted a good time. And here's 2000. So right now, in 2000, it hit a wall, breakdown from this rising trend line, a cleansing cycle, and then there was a recession in the midst of that cleansing cycle. But even if the recession was technically over, the cleansing cycle continued. So either the rates kept going down or there was less public debt, and that resets saturation. Eventually, that multiplier is able to go up. Then after that, look at that, 2007, 8, man, it overshot the 2000 highs, man. So the system really, really stressed, too much debt. Fed fund rates are too high for that debt. What happens? Another new cleansing cycle, huge, much bigger recession all the way down here. A cleansing, go sideways. This is good. Now you're hitting your back to 1967, 1971 lows. The system, the debt is not saturated as much as it used to be. The Fed fund rates are lower. And after that, we start another excess in debt. So debt increases, increases, increases. The rates are probably low. Then when they start raising the rates too much, combined with the debt growing, what happens? Saturated, kaboom. What do we have? We have March Madness, that recession here. Just like clockwork, as soon as that turns down, clockwork, you get a recession. Total here right now. So the debt, even if it's skyrocketed high, the rates are so low that the rate that makes the system sustainable. You could survive. But what continued happening? The rates, either debt continued going up, but even less fast, but then the rates kept going up, and that's crushing, putting a lot of stress on the system. And look at this line. We're back above the 2001 highs, above the 2000 highs, above the 2007 highs. And Jesus, we're about to overtake those 220 highs. So I think at any moment, this thing could implode again. So recession, but we know by the SPX, underperforming the PPI chart, we know that the system has more likelihood of having recessions when growth stocks are underperforming the producer price index. So look, this is a question of time. This thing's going to turn down. It's going to turn down. Probably a Fed pivot or total debt destruction, right? So because for this to go down, debt has to go down, or the Fed fund rate has to go down much more faster than the debt. So this is a total Fed pivot, most likely, unless there's a total debt destruction at the same time, for that to reset all the way back down here. Let's move to the third and final chart, I think. Not even sure. Okay, so this one is the opposite. So this one, I took the total public debt, I divided it. So I adjusted it for the Fed fund rate. So the way you got to see this is not for total debt saturation, but you want to see when the rates go up too much or they start outperforming the total public debt. So that means on the way down. So as this goes up, as total public debt surges against the Fed fund rate, we're in a recession. So that means the Fed fund rate is either they're probably cutting, or the debt staying stable, then we're recession. Same thing here, higher probability of recessions here, same thing here. And look, since 1982, the total public debt has just gone up and up, logarithmically gone up versus the Fed fund rate. So we had Fed fund rate was what, 1980, 16, 17%. So as that Fed fund rate kept going down and down, more and more debt was able to be accumulated. And look at here, sometimes you hit some plateaus. And on the way down here, so when there's a dip, so when the Fed fund rate starts outperforming the public debt, there's a possibility of some type of top US equity, some type of black swan. So here we have it right here in 2000, 2001, goes up. Now even more volatility, we're going down back to the swell, previous resistance turn support. And just as that started turning back up, that hard move down. So that means the Fed fund getting too high for total public debt, because the Fed fund cannot outperform the total public debt too much, right? Because remember that multiplier chart, it makes the system stress, saturated levels. And look at that. The market's already starting to sense, oh, something's wrong. They're starting to cut the Fed fund rates, but the damage is done. And even we're during the recession, while they keep cutting Fed fund rates, a lot of damage done, and that thing goes up to the next level. Same thing here again, rate height cycle. And right here, when they hit that wall, previous resistance turn support, again, oh, they start cutting the rates, but it's too late. A lot of the damage done to the system. Then we have March Madness and implodes. And we're back here. They start a new rate cycle, super aggressive, the most aggressive when you consider the total public debt. And we're about to hit this resistance, previous support, previous resistance turned support, tested here. So I put the circle here. So possible black swan event approaching. And as the Fed fund rate, if they keep hiking and hiking, it's just going to crash the system as you saw in that first chart, right? But eventually they'll start to pivot. And once that starts turning up, then we could expect some more fireworks and more damage in the bear market, a more sustained bear market in US equities. And that will coincide with the SPX breaking down versus gold, opening the gateways for capital flows to go in silver, in gold, in the miners, and to really confirm that pivot from growth stocks to commodities, guys. So that's what I have to say about that, guys. So this is pretty important stuff, man, unfolding right now, but the system is really close to either major system collapse. Look, people are looking for that black swan, but it's not going to be, it's probably already baking the cake, and it's from the looks of that, it has more to do with just maybe another repo madness or U.S. equities getting starched, but has nothing to do with, let's say, Russia or this other type of event. It's going to be related to the debt not being able to be serviced, and that's just going to crunch everything down, guys. All right. Thanks for watching. Ciao, guys.